The bank of mum and dad has become a force to be reckoned with in recent years, helping children out on so many different financial transactions. But in recent years, the bank of mum and dad is being pushed to breaking point. In this video, new research which shows just how bad things are getting for the bank of mum and dad. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice, and in this video we're looking at new research which reveals the state of the bank of mum and dad. Mums and dads, parents, giving or lending money to their adult children to finance a whole range of things, not limited to property purchases, but all sorts of things. And the bank of mum and dad has become a really important force in the world of finance. It's become one of the biggest lenders in the UK in recent years, but it really is, according to this research, being stretched to breaking point. So we're going to take a look together at the research and what it says. Now, the research comes from Interactive Investor. It's part of their Great British Retirement Survey 2020. They spoke to more than 12,000 UK adults to find out, people at all stages of their life, pre and during retirement, what it meant to be part of the bank of mum and dad. The research found widespread support from parents to their children when it came to a whole range of financial transactions, including property. Now, 51% of retired parents had helped out their children financially to get onto the property ladder. 10% loaned money to their children and 41% gifted money. And that number, that proportion of parents who gifted money instead of loaned it, had risen by 6% in the last year. So an increase in the number of parents who are never expecting to see that money back again. It's being given as a gift rather than a loan where repayment is being expected. And a similar number, around half of parents who are yet to retire, anticipate providing some financial assistance to their children once they've retired to help get them onto the property ladder. Now, a slightly worrying figure in this research was that 21% of parents who are still working but over the age of 55 have accessed the tax-free cash from their pension, either some or all of the available tax-free cash, and they've then taken some or all of that money and used it to help their children get onto the property ladder. Now, this one raises some questions about sustainability of income in retirement, because if you're drawing money out of your pension pot early on and you're giving it away or loaning it to a child, that means you don't have that money available to fund your lifestyle in later life. And you have to be very confident before you do that, very confident that you're not going to run out of money before you run out of life. One of the primary goals of financial planning is to make sure you are okay, and we talk about putting your own oxygen mask on first. It's fantastic to be able to help out children and other family members if you can afford to, but without that security of knowledge that you are going to be okay, that you're not going to run out of money during your lifetime, that is a very risky strategy indeed. Now, financial planning, as I'll come on to talk about later, really can help here. It can help you to understand that giving an amount of money away to a child or lending it to them is affordable, is not going to leave you destitute in later life, in retirement, and also when other costs come along later. The research from Interactive Investor also found out about the impact of COVID-19 on retirement plans, and that impact has been significant. They found that 21% of people who are still in work, aged between 60 and 65, have had to delay their plans to retire because of the pandemic. Of those delaying their retirement, 25% said that they were delaying it for a year, 34% said they'd delay it for 2 years, and 23% said they would delay it for 3 years. And sadly, 24% of those who reported having to delay their retirement plans because of the investment impacts of the pandemic said they thought as a result they would never be able to afford to retire. We know that COVID-19 has hit finances hard for an awful lot of people, and that's for people of all ages. So we're hearing in this research about the impact of COVID-19 on the retirement plans of older people. But of course, for younger people, the economic impact of the pandemic has been significant. It's meant job losses and it's meant pay cuts in many cases. So it's little surprise to hear that more younger people are calling on the bank of mum and dad to help fund their lifestyles, to help get them onto the property ladder. That's, I guess, a natural implication of this economic hit. So turning our attention to why children are calling on the bank of mum and dad as their lender, why they're asking mum and dad for money. The average house price has risen by 1,170% during the last 40 years. So where a house used to cost an average of £20,000, the average purchase price has now risen to more than £234,000 today. It's a significant rise, and it's little surprise that to get on the housing ladder, onto the property ladder, children, adult children, are having to ask for financial support and financial help from their parents. And of course, remember that their parents' generation have largely benefited from these property price rises. So members of that post-war baby boomer generation who bought property stock very cheaply have sat in homes and watched the price rise year after year. So many now feel they're in a position, a very fortunate position, to help their adult children get onto the property ladder. And it's not just financial support that children are calling on mum and dad for as well. It's looking at things like unpaid childcare. So in the past year, 29% of retired grandparents were providing an unpaid childcare service for their children. That's up from 18% last year. And again, the pandemic may have had some influence over that rise in the number of grandparents, retired grandparents, providing childcare services. More working grandparents are expecting to provide childcare when they retire, so 36% compared to 20% last year. And sadly, fewer people ahead of retirement believe they'll be able to dedicate time to volunteer work when they retire. That's fallen to 44%, down from 52% last year. So again, I think our changing lifestyles and changing pressures on our time is having a really big influence on how we're likely to spend time in retirement. Now, another growing concern for the Bank of Mum and Dad is funding later life care. So care in later life, long-term care, residential care of some type, if it's needed. Now, 25% of those retired people surveyed said they have actively prepared to fund later life care. So a quarter of retired people, according to this survey, have taken active steps, active measures to put in place financial backing for the cost of care in later life should it be required. And the older people get, the more likely they are to prepare for the cost of care in later life. On average, it was about age 77 where people felt they were the most prepared for later life care costs. But the biggest proportion of retired respondents to this survey, 52%, said they were not prepared at all financially for the cost of later life care, for later life care funding. And that one is a really big concern from a financial planning perspective, because if you've got a high proportion of retired people giving money away or loaning money to adult children to fund property purchases or for other transactions, and they haven't yet prepared for their own cost of care, you potentially have a serious issue coming up and you're storing up problems for later in your retirement. And this is a huge issue. We spend a collective £12.6 billion a year in the UK on later life care costs. And because so many people want to leave an inheritance when they eventually die, we should be very conscious that the cost of later life care can decimate an inheritance payment. It can entirely wipe out an inheritance in some cases. And we know from this research that parents want to leave an inheritance. 81% of the retired respondents said that was important to them. That was a financial priority, to leave some money behind for children and for other loved ones. Now, there is a great argument from a financial planning perspective when it comes to giving money away during your lifetime. When you're alive and you get to see the enjoyment from that money, you get to see your adult children feeling financially secure, getting onto the property ladder, getting to their dream home, maybe starting a family. So that is a really positive thing to do. And informed choice is something that we help our clients with. We help them understand when that's affordable and the best way of doing it, the best way of structuring it from a tax perspective, from a financial planning perspective. But please go into it with your eyes open. Make sure that you have looked after yourself first, that you can afford to see out your days, making reasonable assumptions about the future before you understand how much money you can give away to adult children or other family members. That's so, so important. And we sadly don't see enough people making that sort of planning decision. And this is where financial planning, and in particular the lifetime cash flow forecasting model, really comes into its own. As I said, you could use some reasonable assumptions about the future, about your income and expenditure, about your assets and liabilities, about growth rates and about inflation, about charges and costs and taxes and all sorts of things. And you can understand whether you have enough money to see out the end end of your days? And if so, how much you can comfortably afford to give away now without damaging your lifestyle later in retirement. You can also factor in there some disaster scenarios, like paying for the cost of care at different ages and for different lengths of time, to see what impact that would have, firstly on your ability to give gifts or make loans to children, but also on your ability to leave an inheritance behind. So when that all comes to life through a financial plan, through a lifetime cash flow forecast, it helps us make better decisions with our money. If you're part of the bank of mum and dad generation, do let me know in the comments below what you think about this research. Does it tally with your own experience of giving money or lending money to adult children? And are you feeling any different given the pandemic and its impact on your retirement planning? I'd love to hear from you. Please do leave this video a like and make sure you subscribe to our channel for more videos like this about retirement planning, about investing, about the economy, about all things financial planning. Is what we love to talk about here. Until next time, I'm Martin Bamford. Thank you so much for watching. And remember, when it comes to your money, the more you know, the faster it can grow.